Hey guys, Sierra Bailey here with Accel Commercial Real Estate. The video you're watching ties into our event in June, Accelerate. If you want to learn more about what you see today, scan the QR code on your screen or click the link in the description to get your tickets now before early bird pricing runs out. Enjoy the video.
But it's three things. It's experience, right? So we're looking for similar experience in like-size assets, like-size markets, of 2 years of ownership and operational experience of multifamily. So, high level, that kind of means what it means. In the weeds, for those of you that are really interested to the legal side of this stuff, that means you're on the org chart in a GP, KP capacity. If you open up the
GP, general partner.
general partner. So I once read like investment bankers can't say a sentence without using 5 letters.
Right.
But so if you look inside the operating agreement of that org chart, you are listed as someone who's making managerial decisions on the property. So that's how you get your ownership, right? And we call it the clock starts ticking. So I am about to start my first clock with Freddie Mac. That's so I'm on your thing as investor, and I was like,
Yep,
I'm in.
Yeah.
So there's one component. The second component is net worth. We look for a net worth that is equal to or greater than the value of the loan. And one of the beautiful things that we talked about earlier, non-recourse, since non-recourse is not held against your own balance sheet, it does not create a contingent liability like bank debt does, right? So you do not have to subtract that portion from your overall net worth. I mean, you have to take the liability against the asset, but it's not a contingent liability that we take into consideration, having already borrowed from us before. So in other words, you could borrow $10 million 1,000 times if your net worth is $10 million, right? Which is, you start doing the math, very, very powerful. And then lastly, we look for liquidity, which is the easy way. There's a formula to it, but the easy way to say it's about 10% of the loan amount. And that is, when you're post-closing, you're going to have liquidity of 10%. And then, so a lot of folks start saying, well, shoot, right? And maybe you have ownership, or maybe you have a really high net worth, or maybe you're just sitting on, a couple $100,000 and you want to get into your first deal. And you look at what agency terms are, and you're like, wow, that is significantly better than a bank. And also with a bank's amortization rates and their higher interest rates and some other components, you might even say, I don't meet my IRR that my investors are looking at unless I get agency debt. So how am I going to do it? Or unless I get bridge debt, right? So unless I get one of these more attractive financing pieces, I got to figure out how to get it. So we assume all 3 of those qualifiers in an aggregate pool known as the sponsorship. And the sponsorship is either an individual or a series of partners who bring unique pieces to the table, right? One person may have ownership, one person may have a high net worth, one person may have high liquidity, and we combine those things. And it's also important to know that if you're looking for a net worth of $10 million, if you got one partner with 5 and another partner with 5, we add those together and there's your 10 million, right? So there is an opportunity there from 2 different perspectives. There is an opportunity for folks that may not hit those metrics yet, but are either in control of a deal or trying to get in control of a deal. They may find partnership in someone who, on the other side of the token, has an opportunity to be a sponsor on a deal, to go out and to look for folks that are, maybe missing 1 or 2 of the requirements, and to partner with them and increase their exposure to multifamily transactions, for some sort of ownership component or whatever. There's all kinds of ways to work it out. But
Yeah, so that's the key, what he just talked about too. You're right. So a lot of times people will look at that and they, that's kind of scary, thinking, okay, I don't have 2 years, I don't have this net worth, I don't have, right? But there are individuals out there who, if you have good relationships with people like a Trey or people like ourselves who are brokers, we know people who who are there to, if the deal makes sense to them, if they, the buyers that are going to be looking to buy that, if they are comfortable with them, then they will raise their hand and say, you know what, I'll be a sponsor on that deal for you guys, right? You're, quality individuals. I'll be happy to go in as a sponsor on those deals, right? So I think what Trey's saying is, yeah, that can sound scary, but there are ways that you can work to overcome those if that's your first opportunity, right? To get into multifamily and, hey, saying, I haven't owned it for 2 years. So now what, right? That type of deal. So there is those opportunities to get a sponsor. The nice thing too is that if you first get into it, then, after a number of years, then you yourself can then become a sponsor, right? For somebody else's deals, right? Down the road.
Can
So
one override the other?
As in like having
Tremendous amount of assets over managerial experience.
in like an LP position. Sometimes. So it depends. We have in the past looked at a significant LP
LP
stake. Limited partnership stake, where essentially you're not in control of the deal, right? So most org charts, you have a GP and an LP, right? And the general partnership is the one that's going to sort of
Make
command the
decisions.
deal and manage the operations and make the decisions alongside the property management. The LP are just sort of passive investors that have either negotiated, some portion of return plus cost seg, or just kind of, in there for whatever happens through a waterfall structure. But sometimes,
Just
right?
to know if it was negotiable.
Yeah, it's a conversation. I've seen it happen a couple times where there was such a significant investment over a long period of time within an LP position. And a lot of those folks were able to make the case that, they had been with one GP and, they had made some decisions, right? Like just
Or more down payment.
not to get past qualifiers. I guess theoretically more down payment would lower your net worth requirement, but because the loan would be smaller, but and liquidity requirement, but not to get past those qualifiers. Like that is so we to kind of get into, I don't want to get too deep in the economics about this because literally with that, yeah, but
Keep on.
okay.
Yeah, go ahead, Nick.
Yes.
I almost forgot your name, Nick. I apologize about that. I looked at you and I'm like, Nick, sorry.
I'd ask him the other
Yeah,
day, is it Langford or Langford?
Yeah,
But now I got it.
Yeah.
Could you talk a little bit about when you're going from that bridge to agency or HUD, the sizing of that loan during that refi point?
Yeah,
A lot of us, especially when you're a little bit further out the risk curve, trying to stress test the deal, that's a friction point. So
Yeah.
just from a lender standpoint.
Yeah, that's a great question. So a couple things. So from a lender perspective, we are sort of open-minded to going in debt yields, but stabilized debt yields are what we are stress testing to make sure that the deal can exit, right? And so there is sort of kind of this theoretical idea that for all components to come together for an agency piece, that you need to be somewhere around a 625, 650 debt yield. Now, anecdotally, the yield curve says that right now all of our assets are going to be at 750 debt yield. So, we might be in for fun, but when you're going for the takeout after 2 years with agency, you can start qualifying for a full cash out refi. And that's not just your equity in, right? So essentially what's going to happen is at the end of Y2, Y3, whenever you're done, our bridge piece is designed for 3 years. So let's just say Y3. At the end of Y3, you're going to have a new appraisal done on your property, and you're going to be able to borrow 75% of that value. Now, some of you might be doing your math in your head. You may be like, well, I could probably, with a 40, 50, 60% rent increase and 75% of my new evaluation, I could probably get my debt out, my money out, and an additional $2-3 million on the right size transaction. And you're absolutely right. And it's a non-taxable event because it's a refinance, not a disposition, right? So when you are targeting that out, you're essentially wanting to take your NOI against what you project cap rates will be at that portion, your pro forma NOI against what you think cap rates will be at that time point, determine your new evaluation, and then take 75% of that value. Make sure that your pro forma cash flow would cover a 125 DSCR, and then you're probably in the ballpark. And then from there, you can just kind of start stress testing what type of loan you want up against the. Am I doing it?
No, you're great.
Okay.
I'm just shaking
But
my
Nick
head.
knows what I'm talking about. So
No, I'm just shaking my head going, this is why I know guys like Trey, right? I'm just like, hey, Trey, tell me, do this for me. Tell me this is good or bad. Yeah, no.
Why-
Nick's, he's much brighter. So you understand all that, but guys like me, that's why I'm up here shaking my head, chuckling, going, that's why I know Trey.
Yeah. To not get lost in the numbers, I would say, if you think about what the opportunity there is, it's to take an asset, reposition that asset with some CapEx investment and, some rent increases. And then in 3 years, you're not only taking the debt out, you're taking your own money out, plus you can take even more money out, right? So you can pay off your investors, you can pay off the debt, you can pay off your pref piece if you put a pref piece on there. And then
Pref piece went.
preferred, well, what's really, it's called preferred equity, but it's really not. In our business, it's
Right.
called preferred return,
Right, yeah.
which is big,
Yeah.
sensitive point for me. Which is why you said so, but because everyone says pref ec,
Yeah.
it's just not. But anyway, not on top of all that, you can then be refinancing even more dollars than your entire cost basis into the deal. And it's a non-taxable event because it's a refinance, right? So, when you're evaluating, am I going to depose? Yeah, your IRR is going to be higher if you depose, but the refi is non-taxable. You continue to keep the asset. And if you played your cards right, you are the sole owner of it as the GP who brought in the right amount of LP equity, which, by the way, for our bridge piece, we only require general partners to be 5% of the equity. So 5 of the equity, not the stack, the equity. So if you take 100% of, we fund 87% of cost basis, basically, between the two numbers. You're raising 13% of the cost basis, take 100% of that. If you're 5% of that, you can raise the other 95%, take them out at the end for I think I've done the math one time, for $300,000, you can be you can own a $30 million asset in 3 years. If you, and a lot of it is coming to stuff like this, making the connections to be able to raise the money, to be able to get control of that deal, to understand how to utilize the financing to do that. And then for 300 grand, you too could be a $30 million apartment owner.
That's a great point. That's so you can understand why we hold these educational seminars, because you not only do you gain a ton of knowledge, but there are people sitting in this room here with you that are people you need to get to know, right? After this meeting, you'll have the opportunity to kind of mingle and visit and kind of find out about each other and things like that, because you got a lot of great folks in this room that know a lot of what Trey's talking about that goes way over my head. But I will help you find that deal. But anyway, Tommy, go ahead.
Sure. A couple of questions on underwriting.
Sure.
So we can call them numerical qualifiers, I guess, but what will be some things that we should be underwriting some of our analyses to? Like, I'm assuming 5% vacancy, 8%
Yeah.
gross income towards repairs. Like, what are some other ones that are top of mind for you?
So just standard numbers. Most agencies, so debt service coverage ratio doesn't matter in a bridge piece, but for agency debt, kind of the floor is 125. Expenses are, we evaluate revenue on a T3 basis, and that is revenue is sticky, right? So revenue is what it is. You can't fudge those numbers, like it is what it is, right? And also agencies do not pro forma rent growth. From a expense perspective, you can underwrite your own expenses. We will probably take, some sort of marker to it. But that's also one of the great parts of my job, is to make sure that we have the numbers right and we're sizing correctly. And to that, we then trend those expenses by 3%, right? So that will kind of give you your sort of understanding of how revenue and expenses are working. But debt service coverage ratio inside of agency is really big. And then debt yield for bridge debt is really big. If you bring me a 5 as is debt yield in this environment, I'll move a mountain for you. But I think right now, like we're seeing so many
Yeah.
4s, it's crazy. We were seeing a lot of 3.5s last year and doing them, but I think we all did way too much last year. And we're like, maybe 4s this year.
So what is, so you said you just got kind of back,
From
talked
Kraft.
and talked about with Fannie and Freddie. So what is their outlook for 2022?
That's a great.
Have they thrown out, okay, we've got this much
Yeah,
money
they
to land for 2022?
Mhm.
How does that compare with 2021?
Well, so they've started talking about caps, but not to go deep into politics, but just enough politics for this to make sense. I don't know how much of you keep up with like FHFA and the new director and the Biden administration and kind of what their stance is on affordable housing. But, you know, I mean, if you've been alive, you can probably take a guess. And the outlook is that caps sort of don't matter anymore, or at least for now. And also conservatorship, that conversation is over. So under the Trump administration, they put together a 3-year plan to remove the agencies from conservatorship. Under the Biden administration, that conversation is DOA. So I think essentially what we can look at is that caps are going to be aggressive in terms of good for us. Like there's going to be a lot of money and they're probably going to have a ton of flexibility. So the agencies are likely not going to run out of money. But they have stated that next year they are going to be heavily targeting and incentivizing the properties that have the affordable component of 80% of AMI and 60% of AMI for the vast majority of their tenant base. And they're saying that because it sounds good, and it does sound good, it is good, it's the mission of the agencies, but also the apartment complexes that don't have that are, again, trading at 3.5 caps, so they're never going to size for agency debt anyway. But I think, look, the outlook is good. We have, you know, what they keep telling me is we have insatiable capital on our end, which I know the bogey on our head is like $2.5 billion to do this year. And I think this is just my opinion, and you know, I hope they don't hold me to it, but I think we're going to do 4. And that's just in bridge debt, and then in agency debt, I think it's sort of it's dealer's choice, right? Like it'll be, what do you want to concentrate on? There will be a lot of agency opportunity. There will be a lot of bridge opportunity. You know, for my markets and my client base, I've seen bridge be very popular, but I'm sort of a river originator. I'll kind of go where the water takes me.
Yeah. Okay. So just a couple of things too, and I know before you and I kind of wrap up here, but one of the things I kind of want to say, because we could, like I say, we could talk for hours.
Literally, yeah.
You and I could talk for hours, but some of the one of the things I was going to say, and not to toot my own horn, but one of the things is for Accel Group, for our group, we have 5 of us that do nothing but help people buy and sell multifamily. Like I say, I've done a number of deals with Trey. So the good thing for people out there that may be watching here and here in person with us is it's key too that you go with a broker who's done some deals on the agency side, because that way, you know, so for myself, when I get ready to bring a deal to Trey, I already know what agency is going to be asking for. I know what their underwriters are going to be requiring. I can go look at a property with my buyer and I can walk that property with them and I can tell them, all right, we're going to start writing some notes, kind of like our property manager guys do, like Rick here, and just writing notes of, okay, agency's going to ask this and they're going to require this, and they're, you know, so I already know exactly what agency is going to request that, you know, to be done on this property, right? And I know what, you know, what kind of financial information they're going to be asking for. I know, you know, to get the org charts ready, I know what they're going to require as far as, you know, like he said, some of that requirement of sponsorships, of liquidity. I already know all of that. And so as Trey knows, I hate surprises. And he doesn't like them either, you know, from that standpoint. So I already know going into the deal that make sure my people, my clients are well prepared. and that we have all the information so that we can get it to underwriting, and we know what's going to be requested and required. That way we can get that deal done in a timely fashion, right? So then it's a smooth transaction for you guys and things like that. So, but anyway, we appreciate Trey coming today and his time. And like you say, you can tell he's an extremely bright guy, and he knows all those great numbers, and I let him handle all the numbers.
Thanks for watching this video. If you like what you see, be sure to follow our Generational Wealth Learning series. On select Thursdays, we offer cutting-edge industry information that would normally cost thousands of dollars. And the best part, our education is absolutely free. If you register through our events page, you can join us live, either in person or over Zoom. In the meantime, like this video, comment down below, and subscribe to our channel so you never miss a beat.